Welcome to TheoTRADE. This is Don Kaufman. August 21st, 2024. Just about 30 minutes to go to the cash close here on this Wednesday afternoon. S&P's up, well, a whopping 14 handles right now. But listen, I'm going to begin with there's absolutely no volume. You know, we had BLS data come out today that actually has to do with job revisions. We had, Fed minutes out, and generally speaking, just some short-term bursts of some sketchy trade. But overall, I mean, there's portions of today's trading session. There's just absolutely, there's no volume, there's no liquidity, okay? There's nothing trading right now, but just like a handful of products. And there are really some just huge, if you will, destabilizing market factors that are prevalent in this marketplace. We need to discuss them. Let's get right to it here in this evening's video. As I was showing you, the S&P is, again, not doing a huge amount of volume. I mean, look, wow, we're going to be lucky to do 1 million contracts today in the S&Ps with 30 minutes to go. The volume in the middle of this rally continues to decrease. Now, that's something I've mentioned kind of day in, day out. But overall, in markets, as the volume starts to kind of dissipate, it feels like summer trade, listlessly higher into it. But as I was saying a moment ago, there's some destabilizing market factors that are really prevalent right now. What are they? Okay, so, obviously volume kind of dropping in summer trade, whatever. This is, the last chance to get some vacations in over here. The aspects that are really, I think, cause for concern. Let's start actually with the bond market. So the bond market is at or near recent highs. In fact, the highs that I'm actually pointing out, this rally inside of the bonds, okay, that got us literally to this, 125, kind of 126 handle. And again, I really want to just zoom you into this one particular area. Some of the highest closes that we've seen in recent times have been in and around this 125, 126, hitting 126, it's new closing high. Now, people look at this and they go, yeah, bonds. The bonds are rallying. Why are the bonds rallying? Because interest rates are going to go down. Listen, the Fed's going to drop by a quarter point. The bonds are rallying possibly for defensive posturing. Okay, you're not going to get me starting to think that the Fed fund futures, which are the basically the shortest duration lending instrument out there, you're not going to get me to believe that the 30-year is rallying like this for any other reason than, well, people actually want to go out there. They want to buy the 30-year for what? Well, maybe because short-term interest rates are going down. Yeah, or maybe it's still a little bit of duck and cover. And I'm going to tell you something right now. You should pay attention because here there is volume. You should pay very careful attention. Now, the roll is starting to pick up in this bonds. So you're not going to be able to look at the volume much after basically today. But I will tell you the volume is quite significant in there. The same thing is true, of course, of the notes. So the bonds and the notes, all right, which is the 10-year and the 30-year, are basically at or near some of the recent highs. And again, I want to bring you to this big reactionary. So the big reactionary trade that was done, that is the bonds bursting to the upside all the way to the 126 and 27 ticks level. That actually happened ultimately on August 5th. What were the S&Ps? What were the S&Ps doing, okay, on the day of question? And the answer is that was actually the bottom of the marketplace. Pretty interesting, right? So the spiders have actually rallied right back up, okay? The only interesting thing to me about it is that the bond market has taken a very, very different path. And the bond market, right, was rallying into it and is now rallied back up. So duck and cover, well, we're going to have to play wait and see. It's not just one factor, though, that I would ever consider. All right, next aspect, I think well worth considering over here. With bonds, I also have to look at currencies. And, initially, I started looking at like US dollar. And US dollar is just, it's getting annihilated right now. But then I thought to myself, like, all right, that big sell-off, that big sell-side activity, it was much more about the yen. So I started pulling up like, USD/JPY. And of course, that's the US dollar versus the yen. And you'll find this interesting too, because This is also very, very similar to the other chart we just looked at inside of the bond market, where the US dollar versus obviously the yen is coming very close once again to some of the recent lows. So not unlike, again, is this a critical risk factor in play right now? I believe so. Yeah, obviously something going on in here. In fact, maybe it's a little clearer if we just brought up the yen itself. Okay, take a quick glance. Again, that big reactionary high, same exact day, right? It's August 5th, right? And here we are, present day right here, okay? And we're almost back to those recent highs, very similar to the bond market, all right? Are we having fun yet? All right, what other really big destabilizing market factors are prevalent? Well, let's come into it. Let's go look at something I look at, not continuously, but well worth a read on overall risk in the marketplace is the VVIX, the volatility index. There's still a tremendous amount of hedging activity going on in this marketplace. There's no if, and, or but about it. Like, volatility, okay? There's always a reason behind it. You look at VIX, and VIX is, a function of the S&Ps, but even the VIX, okay? So you can say, well, the VVIX is really high. I mean, before we actually saw the really, really heavy sell side activity, we are getting an incrementally, increasing VVIX. But I do want to show this to you because here we are on August 1st. August 1st, right, is when we spiked to basically that 110 region. Let's go over to the spiders. Let's go to the spiders. Let's actually look back at August 1st. Here you are. Very precipitous drop in the marketplace. Okay, some heavy sell side activity for the rally back. What just begs the question over here, what does the marketplace see right now? What's keeping the volatility index high? Well, obviously it's hedging activity, but what's actually keeping it up here? Something is continually, all right, driving trade and professional trade to feel that the greater world is a little bit destabilized. And even today, with the S&Ps up some 12 handles, you even have the VIX elevated. Okay, once again, now this is getting even more interesting. So a big sell-off over here, back to August 1st, we have the VIX basically at the exact same level. So whether it's VIX, VVIX, okay, getting it done. And one of the last elements in here, the skew. Skew continues to actually pick up. Now skew, it's a little funky to look at skew, but this is now a weekly chart. If you're into it, you can look at daily charts, but you're like, it's a bunch of dots because it's calculated at the end of the day. So you just change the chart over to line. Okay, and you can see that skew has also picked up. Now, okay, where was skew coming into a fairly high risk situation? It was considerably lower. Skew has picked up, which means there's definitely traders that are, in kind of confluence. We're seeing some bond buying, right? Check that, right? The Japanese yen, okay, that's reverted right back where it was before we hit the unwind, if you will, of some of the carry trade out there. All right, what else do we have going on over here? The volatility index, skew, okay? Couple that with the fact there's some low volume and just some really sketchy trade out there. And people, look, you got to keep the game face on right now, because the marketplace, even though we've rallied back up, and I'm not disputing the rally back up. In fact, look, we even hit the upper edge of the expected move today. There's no disputing that, okay? It's that there's still like an echo, if you will, of volatility, okay? An echo, if you will, of extreme risk that's still prevalent in this marketplace, even though you don't see it, okay, resonating inside of the S&Ps. You don't see it per se inside of the Nasdaq. I'm telling you, it's there. It's absolutely there right now. And it just feels like we're like one data point away. And there's Jackson Hole's speech, but look, even before that, chaos couldn't be any one of these data points could be a degree of chaos. Tomorrow you're going to get jobless claims, a little PMI composite flash. Like most of the time, I wouldn't worry about any of these. In all seriousness, most of the time I wouldn't worry about any of these. Now you have to worry about all of these. We hit in the SPX on an intraday basis, we hit the upper edge of the expected move. And the upper edge of the expected move is 56, okay, 56.29. So 56.29, we hit the upper edge of that expected move. We're home. Once again, week in and week out, we continually point out, okay, how efficient, how effective understanding these expected moves. Again, I often say here at TheoTRADE, we do more in there's some of these free videos than most companies would charge you for, because I try to give you very definitive levels coming into the weekend here on Wednesday. Obviously, we hit that level. We've pulled back off of it, okay? But more than anything, even if we hit the level over here, right now, it's not even so much about levels, okay? Trade, very, very light, and it's seeking any data point it can latch to. With that being said, just between now and, of course, the end of the week, there's still quite a substantial expected move. Obviously, the Jackson Hole, symposium is going to keep some volatility in here, right? But there's still $60 of expected move kind of packed into this. And I told you guys this over the weekend, and I'm going to tell you again, okay? The entire week was expecting a $75 move. Entire week was expecting $75 move. Well, we hit that. We pretty much hit it yesterday, but we hit that. Now we're still expecting another $60 of movement. I think you're going to get that and then some, okay? So people, look, strap in. This marketplace might feel a little quiet right now, might feel like it has no volume. As I said, though, there are echoes of volatility in here because there are plenty of destabilizing market factors that are prevalent. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.